Hi everyone, welcome to the second part in our series, Stocks 101. Today we are going to talk about what is a common stock. So Doug, can you tell me what is a common stock?
Well, we're going to use an illustration. In the book, they talk about a company called Rod and Reel, and we've got our fishing equipment here. We got our rod and reel, and basically Rod and Reel is a company that wants to make fishing rods and reels, and they think they have a special product that's different than other ones. But the problem is they don't have enough money to get it started. So they're going to need $200,000 to start their factory, and basically what they do is they issue stock. So stock represents ownership in the company. So in this illustration, we'll say there's $100 a share, and there's 20 shares. That gives them the $200,000. So one share is equal to 1/20th of the company. Now, in the case of Rod and Reel, $100 for a share might be a lot of money, so they might reprice it at 10, and so one share would represent 1/200th of the company.
So what are the rights of owners of such stockholders?
Well, there's a couple, but the first one is they can vote. So each shareholder is able to vote. So let's say that they vote for their one share and it's $10. Their vote is equal to 1/200th of the majority of the vote. Now, sometimes they're not able to be there for the annual meeting, so they can do a proxy vote. They can have someone vote for them. They sign a proxy that allows a board of advisors to do the voting for them. And the board of advisors will represent the shareholders. Now, a lot of times there's decisions that need to be made by a full-time person there, and that's how you get a CEO or chairman of the board.
And so how exactly do stockholders make money off of their stocks?
Well, they're also entitled to the earnings of the company. So if Rod and Reel is doing really well and they make $20,000 in a year, they can divide that up equally to all the shareholders as a dividend and pay it all out of the whole $20,000. Now, let's say they can also say that they need it to grow the business more, and so what they'll do is keep the $20,000, reinvest it, buy more equipment that allows them to make more, rods and reels, and so they can sell even more. Or they can decide to do a partial dividend, so they could pay out $5,000 of that $20,000 and retain the other $15,000 to invest into the business.
And how can you tell the value of a stock? How do you know if it's undervalued or overvalued?
Well, one of the things you'll see a lot or hear a lot is par value. And par value a lot of times is a representation of what the stock originally came out. In this case, Rod and Reel, it's $10 a share. So the par value could be $10. But after the company's been out for a while, the value of the company changes. So the par value never changes. So in essence, it represents nothing. And sometimes you'll actually see par values at like a penny to represent that it's not a real value. The other one that you'll hear a lot, though, is book value. And the way you determine that is you basically take all the assets. Let's say Rod and Reel's grown to $300,000 in their factory and all their different assets that they have. You subtract the liabilities. Let's say it's $100,000 liabilities, and that means that the value is at $200,000. You divide it by the number of shares, and that gives you the price per share or the value. And what a lot of people do is if a stock is selling above the book value, it's considered higher. Or a lot of people try to buy it below. So let's say you can buy Rod and Reel stock for $8 a share, but the book value is $10 a share. Well, you're getting a 20% value on your shares. So that's one way you can look at the value.
And what type of companies are good to invest in as far as common stock goes?
Well, in the case of Rod and Reel, it's a very small, new, up-and-coming company, and it could grow very quickly. So your return on your investment can be a lot in a company like Rod and Reel. But you could also say, well, I want a safer investment, a more established company, and that could be like, say, Hershey would be an example of a large company. It's going to be more stable. It's not going to grow as fast, so you may not earn as much, but you're going to have less volatility. And in between, we have something called a mid-cap or mid-size company, and that could be an example in our area would be sheets or rudders that would be in that category.
Well, thanks, Doug. This was a lot to think about, and I feel like you shined a little light on things for me. So everybody stay tuned for the next part of our series.